18-2 work together. All right, we are Lamber Stores, and we've got a loan payment schedule here and a few transactions that we're going to do. I want to explain this loan payment schedule to you a little bit. So we are borrowing $25,000. The term of our note of our loan is 60 months. Okay, so we got to pay it all back within 60 months. Our annual interest rate is 9%. And our monthly payment is $518.96. And so for basically for 60 months, you're going to pay back $518 every month. All right. So down here, it breaks it down how much each payment is worth in interest and in principal. So you borrow $25,000. You make your first payment of $518. Only $331 actually goes toward what you borrowed, which is called your principal. $187 of this, of your monthly payment, is just interest, which simply means you are paying the bank or whoever loaned you the money. This is just free money you're giving them, saying thanks for letting me borrow from you. Okay, the $331 actually goes towards subtracting off that $25,000 that we started with to say we now owe $24,668. Okay, so every month, as you make your same $518 payment, the amount of interest that is in that payment goes down, and notice the principal amount goes up. The reason for that is at the first month, we owed $25,000, so 9% of that is $187. Well, in the second month, we made a little bit of payment, right? We paid off $331. So now we only owe $24,668. So 9% of that is a little bit less, not much, what's $250 basically, but it keeps going down. So the amount of interest every month that you're paying gets to go down, while the amount that you're paying towards principal goes up. Okay, so every month you get to subtract a little bit bigger amount until you owe zero. All right, so just a little bit of information about a loan payment schedule. All right, our first transaction on June 1st, we signed a 5-year 9% note for $25,000, receipt $337. So that's kind of a clue saying, hey, this needs to go in your cash receipt journal. Okay, this note goes along with this note payment here. Okay, that $25,000. But right now we're just saying, hey, we borrowed $25,000 and we got to put it into our books. So go to your cash receipt journal, and on June 1st, and our account is going to be long-term, I don't think they capitalize it, notes payable. Okay, so in section 18.1, we just had notes payable because we were paying it back within like 60 days or 90 days. This is a 60-month loan, so that's 5 years. So basically anything over a year worth of time that we're borrowing is going to go into long-term. Okay, our document number is receipt 337. And what we're doing is we're in our cash receipt journal, so we have to have a cash debit. We borrowed $25,000, so that goes there, and our credit is going to be general, because if you think about it, none of these special columns here make sense. We're borrowing money. We didn't make a sale, and we're not supposed to be getting any money from anybody. This is just money that we borrowed. Okay, cash receipt journal. All right, so that's your first transaction. July 1st. We issued a 20-year 6% $5,000 bonds worth $200,000. Receipt $345. So we are basically allowing people to buy bonds for our company, which gives us cash, and we pay them. It's kind of like a mini loan that we pay back over time, and it's a good investment for other people, like for regular people like you and me, into a business, because since it's a bond, we're guaranteed that 6% interest rate. If we were to buy into the stock market and just buy like a stock in a company, we're not guaranteed anything. We might get our money back, we may not. Okay, you could get $0 if the company goes bankrupt. In this situation with bonds, you're guaranteed that 6%. Now, obviously, if a company goes bankrupt, I mean, there's different issues there. But here, you're guaranteed 6%. Okay. All right, so again, this is going to be in our cash receipt journal, and it is on July 1st. And this time, we are calling it bonds payable. Okay, so we know we issued bonds. We issued 20-year 6% at $5,000 each for a total of $200,000. Okay, so what we're going to do is in our cash debit column, we're going to put $200,000. And again, it's going to go under general credit because we're not making a sale. We're not doing accounts receivable. We are just handing out bonds, which is not what our company sells. Okay, that's just a way to kind of take out a loan, but instead of doing it from a bank, you allow any old regular person that wants to buy a bond to buy it and give you the cash. Okay, so that again is receipt 345. All right, so now we go to December, and we're gonna pay cash for a December payment on our June 1st note payable of $518. Okay, so obviously we've skipped a few months. We're not doing transactions for all of these, but I mean, we did make a payment in July, August, September, so on and so forth. But we are dealing with December right now. Okay, so our $518 payment in December, $174.88 is interest, and $344.08 is principal. Okay, so cash payment, paid cash, so go down to your cash payment journal, and this is on December 1st. All right, so we're making a payment to what we owe. So if you remember up here, when we took the money out, we put it in long-term notes payable because that's that 5-year loan. So as we pay it off, we take it out of long-term notes payable. Okay, this is a cash payment, so it was check number 842. And so since we are making a payment, it has to be over here in cash credit. Okay, and the amount, our monthly payment is always $518.96. The things that change is how much goes towards principal and how much goes towards interest. So our two debits are going to be long-term notes payable and interest expense. All right, you don't have to do any calculations. You just have to remember to come up here to December, and this column is interest. Okay, so December is $174.88. So our interest right here, $174.88, and the amount that actually goes towards principal in December is $344.08. Okay, and if you were to add those up using your calculator, 344.08 plus 174.88 is your monthly payment. All right, $518.96. So that's the December 1st transaction. Next up is December 31st. We are paying cash for our semi-annual interest on the bonds. So if you remember, we issued all those bonds to all those people, and now we got to start paying cash on them, okay, paying the interest for them. So I did a little calculation up here so you can see it. It's the same as your interest loan that we did in the last section. You take how much money we borrowed, or in this case we issued in bonds, $200,000, times your annual interest rate. Okay, and so then you have to make it for the amount of time that we're paying. So it's a semi-annual payment, which is twice a year, so half of our year. So half of 360 is 180. Okay, so 200,000 times 0.06 times 180 divided by 360 is $6,000. So we're making a payment of $6,000 on all those bonds. All right, so again, down in our cash payment journal, December 30th, and this is going to just be interest expense because we are just paying on the interest. Okay, our check number is 861, and the amount is $6,000 that we're paying in interest. So under cash credit, $6,000, and our general debit is also $6,000. Again, our special columns don't make any sense here. It's not a purchase. It's not accounts payable. We're just paying out our interest. All right, and that's it.